The psychology of investing. Investing is not just about numbers and strategies. It's deeply rooted in psychology. Our emotions, biases, and behaviors play a significant role in how we make financial decisions. Understanding the psychological factors at play can help you make better investment choices and avoid costly mistakes. Fear and greed. Two of the most powerful emotions in investing are fear and greed. Fear often leads to panic selling during market downturns, while greed can drive investors to take excessive risks in pursuit of quick profits. For example, during a market crash, fear might compel you to sell your investments at a loss, even if the downturn is temporary. Conversely, greed can push you to buy overvalued stocks during a bull market, only to face losses when the market corrects itself. Herd mentality. Many investors tend to follow the crowd, assuming that if everyone else is buying or selling, it must be the right decision. This herd mentality can lead to bubbles and crashes. For instance, buying bonds or land for farming because everyone else is buying, only to see the bubble burst. Loss aversion. Studies show that people feel the pain of losses more acutely than the joy of gains. This loss aversion can lead to overly conservative investing or holding onto losing investments in the hope they'll rebound. Such behavior often prevents investors from making rational decisions and reallocating their portfolios effectively. Overconfidence. Many investors overestimate their ability to predict market movements or pick winning stocks. Overconfidence can lead to excessive trading, which not only increases transaction costs, but also exposes your portfolio to unnecessary risks. Research shows that frequent traders often underperform compared to those who adopt a long-term approach. Anchoring bias. Investors often fixate on specific price points or past events, such as the price they paid for a stock. This anchoring bias can make it difficult to adjust to new information or changing market conditions, leading to missed opportunities or holding onto underperforming assets for too long. Overcoming psychological traps. Have a plan. Create a clear investment strategy based on your financial goals, risk tolerance, and time horizon. Stick to this plan even during market turbulence. Diversify. A well-diversified portfolio reduces the impact of market swings and minimizes emotional decision-making. Focus on the long term. Markets fluctuate, but staying focused on your long-term goals can help you weather short-term volatility. Avoid emotional decisions. Take time to reflect before making significant changes to your portfolio. Consulting a financial advisor can also provide an objective perspective. Investing successfully requires more than financial knowledge. It demands emotional discipline and self-awareness. By understanding the psychological factors that influence your decisions, you can build a resilient portfolio and achieve your financial goals.